So, first of all, why this matters? Why would you show up tonight? Why would you listen to me? Why would you even think about psychology, risk management, all this stuff? If you're already a trader, you understand how important it is. If you're new to the game, then that's different. But why it matters is because most traders fail off reasons that have nothing to do with strategy. Technical setup might be perfect, but without proper risk management and emotional control, even the best strategies crumble, and that is the truth. Risk and psychology determine results more than entries. So, it's not obviously like you still have to be a good trader. You still have to have good strategy. You can't just take random trades with good psychology and risk management, but you can have mediocre entries and still be profitable with really good risk management and psychology, and I will stand on that. Success comes from behavior, structure, and emotional discipline. The market rewards consistency and not brilliance. It's not about coming up with the most technical, complicated, all these different indicators, strategies. It's about being consistent and having tight risk management. That is where the real competitive advantage lies. That is why there are people out there, making millions of dollars a year, $2 million, $3 million, $4 million a year, making 100% returns without working for anyone else, and they're doing it all just by themselves, because basically what they're doing is they're not brilliant in any type of way, but they are very, very consistent at what they do, and they are very, very good at emotional control and risk management. So, the truth, and this is something that I really, really, really want to harp on, because I have a lot of people come to me saying, I'm so dedicated, I'm going to put in the work, I'll spend 16 hours on a chart, I don't care, I'm going to put my all into it. But that's not how trading works. It is not like something that you can put your full forth effort into and you'll be successful. Your mindset does not equal your motivation. Your mindset equals how well can you follow rules, because the market rewards emotional control, not emotional reactions. And so a lot of people, I have a lot of very, very accomplished people who, were D1 athletes, were, head of companies, marathon runners, ultra runners, or like whatever, just very accomplished people who have proven discipline and proven grit and determination, and can't seem to stick to trading rules. And the reason because of that is because trading is something where the best thing to do is to not do anything a lot of the time. And people who have the notion that if you just put in more effort you'll get further, that ends up actually being your downfall, because now you're overtrading and now you're making mistakes that you could have avoided by just doing nothing. And sitting on your hands is a lot of the time the best thing to do in trading. And so motivation fades when things get hard. Rules keep you anchored when emotions scream at you to break them. Your mindset isn't about positive thinking. It is about a framework that guides your decisions when fear, greed, or FOMO show up. And so I posted a video on my Instagram story that was like a little bit comical about just me getting frustrated at a trade that almost hit my take profit today. It was a little bit for content. I am a very, very stoic trader. If I were to post all my trades, which I'm going to start posting a lot more of my trades, just of like recordings of my live trading, you can tell I'm very bland. And so if I'm ever being very comical or emotional or expressive, it's primarily just to make the video more, fun to watch, because a lot of the time I just sit there and look at the screen and I might lose money, I might make money, but you can tell that, my facial expressions and everything like that stays very, very boring, because trading eventually gets boring, and we're going to talk about that in a second. But that's goes to show that where it's about having a framework and not really about, making emotional decisions. All right, your number one job as a trader, this is going to be kind of annoying for a lot of people, but it's not to make money, it's to protect capital so you can stay in the game long enough to get good. And every professional trader will tell you the same thing. Your first job is defense, not offense. If I wanted to make $1 million tomorrow, I would full port all my money into some crazy 0 DTE options, like whatever trade. But that's not, like, my goal is not to make the most amount of money possible in the shortest amount of time. It's about to make consistent profits and stay in the game, to eventually have those days where I can, bet $100,000 on a trade, and it's not that big of a deal. But to actually build your capital, you need to be able to protect it and not just take, large trades. And that goes with funded accounts as well. Obviously, it's way different, because a $50 funded account is way different than losing like, $1,000 on a trade with your own personal capital. But you still need to use funded accounts accordingly and, follow the rules so you can get payouts, but not just like full port them so you have to just keep starting over. And so number one job as a trader, defense over offense. And that is why, and I'll talk about this too, but like that is why I have 65 close to 70% of my assets in longer term investments. I do not day trade with, 100% or like, I don't know, even like, I day trade with like 10% of my money that I could trade in my trading account. Why? Because it is extremely risky and I care about preserving my capital as well. So, the risk formula. Risk is not just about where you place your stop loss. It is a multi-layered calculation that accounts for every variable in your trade. So, obviously, position size. How many contracts or shares you're trading relevant to your account size? This is so important. Also relative to your stop loss placement. Your stop loss placement should be where the trade is invalidated to exit, so you can protect your capital so that if the trade keeps going in the opposite direction as you thought it would, you don't lose more than you should have. And then volatility. This is a big one recently. How much the market is moving. Higher volatility requires wider stops or smaller size. If you were trading with me back in the summer, I know a few of you were trading with me back in the summer, I was, having 2-3 point stop losses on ES. Now I have, 4 or 5, even up to like 8 or 9 point stop losses because we are in a much more volatile environment. Things are moving way further than they normally did when you look at a daily range, I guess you could say. And so that's something to note when you are trading is how much does something typically move in a day relative to how big my position is. And then the time of day, obviously market open and close are more volatile. Midday can be choppy and unpredictable, similar to nighttime. Overnight trading, Asia session, London session is going to be a lot more choppy and unpredictable. And that's just something you have to be aware of when you're determining when you're going to take a trade. And then emotional state. Are you calm, focused, clear, anxious, rush, reactive? That is something that is going to be, it's going to affect your risk and your risk sizing. So if any of these are off, the trade is already lost, in my opinion. Don't fight it, skip the trade, wait for everything to align. And that's okay. No trade is sometimes the best trade. Sorry, guys, I'm still a little sick. All right, there are 3 types of trades that I trade. Breakouts, continuations, reversals, that's it. So, risk profile, tight validation, higher failure rate. It is what it is. Breakouts have been super profitable as of recent because we have had these large drastic moves in the market, but they are exciting but dangerous. Your edge comes from strict validation, waiting for candle close. So a lot of breakouts fail, and that is why I kind of wanted to have the risk profile on here, saying that you need tight validation, but it does have a higher failure rate when you actually go and really understand, the profile of these trades. So, volume confirmation, clean structure, use smaller size because failure rate is higher. Continuations is the safest risk to reward ratio. These are bread and butter in trading markets. This should say trending markets. The trend is already established. You're just joining momentum. The trend is your friend. So your stops can be placed at logical supply and demand or volume nodes. Continuations offer the best probability and cleanest risk management. I'm so sorry, guys. I'm like I'm starting to get really, really sick here. It's okay though. We're gonna get through this. Reversals, lower probability, highest reward. So these are gonna offer the best risk to reward by far. Reversals often require multiple confirmations, patience, and acceptance of frequent losses. Reversals are not always easy to catch, but only take these when other conditions are favorable. So reversals are basically where you're going for those like big wins. I would say for the most part, you're having a lower, basically tighter stop loss, but way better risk to reward. All right. The truth about stop losses. If your stop is emotional, it's not a stop. A lot of people will say, oh, I have a manual stop loss or I have a mental stop loss. That's BS in my opinion. A real stop loss is based on technical invalidation, not how much loss you could tolerate. So if you're setting your stop loss based on just like a dollar amount, not great. If you're setting your stop loss based on a percentage amount, not great. You should be setting it to where there's a technical invalidation and you should be position sizing accordingly. And also not just like a mental stop loss. It's not a real thing. Stops belong at invalidation, not comfort. Your stop should be placed where the setup is proven wrong, not where you feel safe. Bigger stops does not always equal bad if your size is correct. A wide stop with tiny size can be normally safer than a tight stop with huge size. Obviously, if you're like a scalper or something like that, things might be a little bit different. But when it comes to my strategy, I will have tighter stop losses on smaller trades because I can and because if that's what I have to do for the trade to be valid. Tight stops plus bigger size equals disaster. This combination guarantees you'll get stopped out. Normal noise without risking too much is the fastest way to destroy an account. I find a lot of my beginners do this. They risk way too much and have really tight stops and then just end up losing, even if it's just only 3 or 4 trades in a row, they've already blown the account. Stop loss is your safety net. Respect it, honor it, never move it wider once you're in a trade. All right, risk per day rules. 2 to 3 trades a day max, quality over quantity. I break this rule sometimes and I'll take 4. I shouldn't break it, but I'm just being honest. More trades does not equal more profit. They normally equals more opportunities to make mistakes. Daily trade limit, stick to it religiously. I have a 4 trade daily limit, but I honestly have been thinking about moving it to 3. If you hit a max loss, stop. Once your loss is predetermined, daily maximum usually 2 to 3% of your account. Shut it down, walk away, close the charge. The markets will be there tomorrow. No revenge trading. No revenge trading. The urge to make it back is the most dangerous impulse in trading. Your ego talking, not your strategy. Revenge trading turns small losses into catastrophic ones. I have heard this story. I've done this to myself, even probably more times than I'd like to admit, where you take a small loss, maybe take another small loss, and you get really frustrated, and you over leverage, you oversize, and you end up losing way more than you anticipated if you would have just stopped for the day. And so this is where that just one more, once you hit your trade limit or you're feeling emotional, that voice just saying just one more trade is lying to you. It never ends well. Trust your rules, not your impulses. And if it does end well 1 or 2 times, it will not end well the next. And so it's very important just to be aware of that. Your job at the end of the day is to stay sane, not rich. And I wanted to write this because if you keep your sanity, eventually the profits will come. So consistency will compound. Sanity preserves capital. If you end every day calm, clear, and in control, the profits will follow naturally over time. If you end every day frustrated and mad at yourself and telling yourself oh, why did I do that, or why did I take this trade, or I over leveraged, or why did I build this account, you're gonna drive yourself crazy. And that is normally what the first 6 months of trading looks like for a lot of people if they don't have the proper rules around it and also proper mindset. And so make sure you're keeping yourself sane. And there's something that I want to bring up about this, about how there was just this crypto hedge fund guy that just killed himself in the crypto market dump, and it's really sad. And trading is something that you need to be able to keep your sanity. Don't let it drive you insane, and that the market is always going to be there, and make sure that you're managing your risk accordingly. If you're making trades with money that you need to pay rent, or you need to survive, then I'd recommend using a funded account, because you shouldn't be at a place where your trading is really going to affect your survival. Why psychology matters. You don't trade the market, you trade your beliefs, fears, and impulses against the market, and this is 100% true. The reason, I don't know, I kind of messed up the way this slide looks, but that's okay. The real reason traders blow accounts, not because they don't know how to trade, because they can't control themselves. You can have the best strategy in the world. If you can't control your impulses, you will still lose. Most blown accounts aren't the result of bad trades, the result of emotional hijacking. And what that really means is just your emotions completely taking over. Impulsiveness, jumping into trades without confirmation because you feel like it's going to move. I might say this in my live stream sometimes when I'm live trading, and that's completely my fault, because I say I feel like it's gonna go this way. I should be a little bit more clear on what I mean by that, because normally when I say I'm feeling something, it's because there is some type of indicator that is pushing me to add to a position, to subtract to a position, and that's normally just out of market structure movement or candlestick movement. It's not really I just feel it, I feel like it might go my way. No, it's I'm observing the way that the market is moving, just out of pure experience. I'm okay, wow, this trade is not going my way, so I might exit early, or stuff like that. Overconfidence. This is a big one as well. Winning streaks cause the illusion of invincibility, then one oversized trade wipes it all out. I have done this to myself twice, where I have lost 80% of my account on one day because of overconfidence. I was consistently making 2 to 3K a day back in 2020. Right when COVID hit, the markets were going crazy. I was making a lot of good money then for a solid 2 months. And then I blew it all in 2 weeks. Over leveraging, overconfidence. I was getting, really lucky in a very volatile market, and I had no idea what I was doing when it came to risk management, when it came to emotions and stuff like that. And so overconfidence is a real thing. So when you're on a winning streak, and honestly, this is something I just had a really, really big month in November. And if you've noticed, I've switched to only trading my funded accounts as of recent, not only, but primarily trading my funded accounts as of recent because of this overconfidence, emotion that, I don't want to give back my profits from last month. December hasn't been the best price action. And so I am, adjusting my way of trading accordingly, given that I know that I probably have those overconfidence emotions after having a really big month. And I know that the conditions are probably not going to be as great anyways. And so I just kind of wanted to highlight that a little bit. But FOMO, everyone knows this one, chasing trades that already moved. It happens. And then wanting to make it back, we just kind of talked about this one as well. When it comes to FOMO, another thing that I want to address about this is comparison, because you could scroll on TikTok, on Instagram, and you're seeing like, everyone making these great trades and everyone making thousands of dollars and everything like that. But my opinion on it is that don't even care about what anyone else is doing, as long as you are beating be better than yourself the day before when it comes to just, emotions, practice, stuff like that. It's not really like about the profit. It's more about like, did you follow your rules? Did you make a good trade today? Stuff like that. I think it like is the best thing. Yeah, great advice in general. Thank you. I appreciate that. Great advice for just life in general. Okay, behavior and skill. Most losing streaks are behavior problems masquerading as strategy issues. Stop blaming your setup. Start examining your actions. So obviously, this is important as well. Are you overtrading? Are you moving your stop? Do you have no plan? Are you entering too early? Are you entering too late? Are you taking random trades? If you're consistently losing, asking yourself, is this a strategy problem or a discipline problem? And every single time when I have one of my students come to me and they say, hey, Kenna, like I'm on a losing streak. I just blew my funded account. I don't know what I'm doing anymore. I'm so confused. First thing I ask them, is this a strategy problem or is this a discipline problem? Is this a strategy problem or is this an emotions problem or risk management problem? Because those two things are the way that they need to be addressed, the way that they need to be fixed are completely different. And discipline is fixable, but only if you're honest about it. So if I'm catching you lying and I'm saying, hey, how many trades did you take today? And you tell me you took 13 trades today. Well, this is a discipline problem. I'm not going to take it as a strategy problem because your strategy might be working and you just, took 5 times the amount of trades that you told me you were going to. So that is two different, ways of, completely different problems when it comes to like how can I help, how can I address what's going on here. Your nervous system rules your P&L. If your heart is racing before a trade, you're not trading, you're gambling. If your mind is chaotic, your entries will be chaotic. Calm nervous system, calm decision making. I like to pray before I trade. I'm religious, so I like to pray. Some people will meditate, some people do breath work, some people like to read, some people like to journal. Find something that gets you in a space where you're prepared for trading. You watch the market open, you're calm, you're not like freaking out, you're not like stressed or ready before you even enter a trade. Those are all things that are going to affect your trading, and so making sure that you're in a calm mind, a stable mind before you get into a trade is important as well. Confidence is not affirmations. You can yell at yourself in the mirror, I'm a profitable trader, I'm good at trading, I am going to be a millionaire. You can yell at yourself as many times as you want, but confidence is executing the same behaviors over and over until it becomes your identity. And I'll stand by this because I am a whole believer in manifestation and, all these types of things. But you can only manifest and affirm so many things without action before they just kind of start becoming superficial. And confidence is in executing the same behaviors over and over until they become your identity, until it becomes irrefutable that that is who you are, not just saying it, in the mirror every day. All right, this is something that I also want to address super quickly, and I know I kind of owe this to a few people when it comes to just like having a checklist. This is not, obviously this presentation has not been like very much, hasn't been based on like strategy or anything like that. This is more just like a broad-based presentation on, risk management and psychology, but I kind of just wanted to address a few things here. Pre-trade checklist, if all are yes, take the trade. If any are no, skip. Clear bias, do you have clear directional conviction based on structure, not hope? Valid setup, is breakout, continuation, or reversal that fits your strategy? Has a candle closed in your favor, or are you jumping the gun? This is more for breakouts. Can you have a clean stop placement? Is it at a clear logical invalidation level, or how is the risk to reward on the position basically? Correct size, does your position size respect your 1 to 2% rule? And no emotional triggers. So are you calm, clear, and focused? Pre-planned, take profit. Do you know exactly where you're exiting before you enter as well? This checklist is your gatekeeper. It protects you from impulsive trades, emotional decisions, and preventable losses. Use it every single time. If you listen to me on my live trading, you will hear I am like, okay, is this a valid setup? I like plan the trade before I even enter it. I am marking my stop loss, my take profit. I'm looking at the risk to reward. I'm looking at the entry. I'm seeing what's happening in the candlesticks. I'm waiting for like a setup that I like. And you'll see that I plan for probably like at least 5 or 6 trades a day that I don't end up taking. Where I'm like, oh, okay, like this setup looks good if this XYZ presents itself. And most of the time it doesn't present itself and I don't take the trade and I wait for the next setup. But you'll see that I do that on my live sessions where I'm like, okay, here's where I would enter, here's where I would place my stop loss, here's where I would put my take profit if this XYZ like kind of pattern of events happens. And if it doesn't, then I'm not taking the trade. And it is what it is. Journaling, your most powerful tool. So journaling turns mistakes into data. Data turns data into mastery. So what that really means is that you can't fix what you don't measure. You can't fix what you don't understand. And so most traders will repeat the same mistakes and never document them. They trade, they lose, they feel bad, and they move on, and they do it all over again the next week or the next day. Journaling will break the cycle. It forces you to confront your patterns, and this goes beyond trading as well. I think that okay, sorry. It's not about writing essays. It's not about explaining exactly what the trade was. It's about really understanding what the role of the strategy played, what the role of your emotions were, what happened that day, how you feel about it, and also market conditions and stuff like that is important to make note of. But just blindly taking a bunch of random trades every single day is going to get you nowhere if you don't track them. So yeah, an example of a good entry. What was the setup? Was it a breakout, a continuation, or a reversal? What was the market structure? What time frame were you on? Why did I enter? What was your thesis? Did you follow your checklist, or did you enter impulsively? Did I follow my checklist? This is the next question. Yes or no? Even if you made money on the trade, did you follow your checklist? Did you follow your plan? Be brutally honest. If no, why not? What made you break your rules? So this would be like, did I over leverage? Even if I made more profit? Did I take an extra trade? Even if I made money? This is just important to note, because for the first 3 months of my trading, I was making profits, but every single time, did I follow my checklist? I would answer no. It was because I was over leveraging, I was over risking, I was over trading, but I was still making money. But then I obviously blew it all up, 6 months later. But that is why, is because literally every single time I look back at my journal, it's like, did I follow my checklist? No. And I would just write no, because I didn't want to confront the fact that I was still making money, yet breaking every single one of my rules, which was obviously unsustainable, and so I don't recommend that. Did I break rules? List every rule we violated. No judgment, just awareness. This is where you're just being honest with yourself. What emotion was in control? Fear, greed, FOMO, revenge, boredom, name it, you want it. This is, this could also be just calm. I was calm in this trade. This could be a good emotion. Just tracking those is important. What would the future be done differently? This is helpful as well. This can help you kind of rewrite the script. This can help you identify, your next better patterns, and really become the trader that you want to be, I guess you could say. How are you finding volatility? Are you looking at realized volatility from the last 14 days or average true range? I really only look at the VIX when it comes to volatility. So obviously the VIX has taken a dip, but yeah, I'm not exactly sure what you're referring to, but that's pretty much all I really look at. And just I look at the market every single day. So futures VIX, VIX. So right now I think, what is it at? 16 today, which is not high at all. It's honestly decently high. Yeah, 15.8. 15.8 is not bad. Normally you want something a little bit higher, but that's not terrible. Okay. Rules that save accounts. These are not suggestions. These are non-negotiable boundaries. No trading when tired, angry, stressed, or rush. This is important. Your state determines your decisions. If you're not calm, clear space, and you have no business trading. Close laptop, walk away. It is what it is. No trading after huge wins or losses. I think that this helps a lot of traders because it definitely gives you a better idea about that trading's always going to be there. So big wins create overconfidence, big losses create desperation. Both states lead to terrible decision making. After a significant win or loss, take a break, let your nervous system reset. No adding to losers. Averaging down is a fancy term for throwing good money after bad. So there is a difference between dollar cost averaging when it comes to investing, and then adding to a losing day trade. Those are two very, very different concepts that one is good and one is bad in my opinion. So when you're investing, and for example, I just dollar cost averaged into Bitcoin. I bought a decent amount of Bitcoin and Ethereum about a week ago when things were pretty low. Now, would I add to a losing day trade? No, I think that's a terrible habit to have. And so if the trade is going against you, it means your thesis is wrong. Why would you compound the error? You're just basically taking more of a loss than you needed to. And so, yeah. Only add to winners when the trend confirms. I did this today. If you're going to scale into a position, do when the market is proving you right, not when you're hoping it will turn around. So what was I seeing today? I added to a position where I was going short. And basically what happened was it was holding below the point of control, which is where the highest amount of volume is being traded. And so what was happening today is I was in a short and things were proving to kind of reverse, and it was kept rejecting a higher level. And so what I did is that once my trade was slightly in profit, I actually doubled the position and it went my way. But I waited for my confirmation to add to that winner, and I also tightened my stop loss. And so it's very, very important to be able to scale into a position when things are proving you right, not when things are proving you wrong. And then if you don't know your stop, you don't have a trade. A trade without a defined stop loss is gambling. I'll stand by that forever. If you can't identify where your setup is invalid, you're not ready to enter, and it's probably not that good of a trade. Oh, I see this question. Where do I like my VIX at? Above 20 is normally what like the standard, I guess you could say, for like good volatility is. But that also, good volatility doesn't mean that you're like gonna make money. It just means that things are moving a lot. So I think that it's important to understand like that aspect of it. But I've traded in all environments. I've traded at where a VIX is at 12. I've traded at a VIX at 40. I don't really care about that, to be honest. I will still take scalps. I'll just be going for smaller trades in terms of points, but I'll still be going for I'll have tighter stop losses, tighter take profits when the VIX is lower. If that's the question that's being asked, I think. Okay, the identity shift. Consistency isn't something that you do, it's something that you become. You become it by shifting your identity from someone who trades hoping to win to someone who trades knowing they'll follow rules. Stop needing the win. Detach from the outcome of any single trade. Your job is not to be right, it's to execute a plan. Wins and losses are data points, detachment is power. Start needing to follow your rules. An obsession shifts from profit to process. You start caring more about whether you followed your checklist, whether you actually made money. This is the turning point. This is the turning point for a lot of traders where people will realize that this is where you actually start to make a lot of money, is when you almost stop thinking about the money and you think about it as a process. Trade like the version of you who already succeeded. Future you, the one who's consistently profitable and doesn't break rules, doesn't chase, doesn't revenge trade. Embody the version of you now. Act as if you've already made it, because that's exactly how you get there. The shift happens. Following your rules feels better than making money. When you'd rather take a small loss perfectly than win sloppily, that's when you know you changed. And obviously it doesn't feel great at first, but like I think the past 2 days I've had like smaller day. Yesterday I had a good day, but the day before that not as big. And I had 2 losses today, or one real loss, but one basically like break even. But what I will say about that is that when a loss is very contained and very small, it doesn't like affect me, versus a loss or versus a win that was from like over leveraging or over trading, or I broke a rule or stuff like that. And so when you start to like recognize that in yourself, where you're like, okay, I followed this rule, maybe I still made profit, but it almost feels like bad. That's when you know that you're like going on the identity shift of like, okay, I want to be a consistent trader. I don't just want to be like a gambler that wins once in a while. A contained loss still feels like a win. Yeah, exactly. Consistency comes from board trading. So I did want to talk about this a little bit. So your best trades won't feel exciting. They will feel obvious, simple, and almost boring. Boring equals profitable. If trading feels like an adrenaline rush, you're doing it wrong. The traders who make real money, their days are monotonous. Same routine, same rules, same execution over and over and over. Trading starts to just get kind of boring. The exciting trades, the ones that get your heart pounding, are usually ones you shouldn't be taking. They're driven by emotion, not logic. The boring trades, those are ones that build wealth, the one that align with your plan, the one that you take without hesitation because they check every box. If you're looking for excitement, go to a casino. If you're looking for consistent profits, embrace the boredom, master the mundane, fall in love with doing the same thing correctly every single time. I do still take like aggressive trades, but they're not ones that I would like, tell people to do. They're because I am like willing to take big losses, or bigger losses. But if you're looking for consistent profits, that's not the way to do it. If you want to gamble, go to a casino. If you want to gamble, pick a direction and go long or short that day. But your adrenaline rush should not come from trading. There's a lot of other places to get adrenaline in life. Trading should be one of the most boring things of your life. Mastery equals simplicity. Fewer decisions, fewer emotions, fewer trades equals more clarity. Beginners complicate, experts simplify. The more experience you gain, the less you need. Fewer indicators, fewer setups, fewer trades, more space, more peace, more profit. So, fewer decisions, cut out the noise, trade 1 or 2 setups that you know inside out. Reduce variables, simplify your strategy until literally a child could follow it. I'm still working on finding a way to articulate my strategy, because I do trade like probably 5 setups at the moment, and so I'm working on a way to really simplify it. So it is literally like so bulletproof, where it's literally so simple, that anyone can learn it, because you want to have fewer trades, quality over quantity, wait for A+ setups, let mediocre opportunities pass. Your edge comes from selectivity, not activity. Fewer emotions. When you know exactly what you're looking for, there's no room for doubt, no second guessing, no emotional turbulence. You're just executing a plan. More clarity. Simplicity creates space for clear thinking. You see the market without clutter. You act without hesitation. You trade with confidence. The goal is not complexity. The goal is mastery through simplicity. Strip away everything that doesn't serve you, and what remains is your edge. You have everything you need. The strategies, the rules, structure, it's all here. Now it's just about implementation, execution, and discipline. You don't need more information. You need more repetition, consistency, and trust in your process. The market rewards emotional control, not emotional reactions. Your mindset equals your rules. So, go build a trading career you deserve. One boring, disciplined, rule-following trade at a time. This is super lame, but I did kind of just want to note that, because I feel like it is one of the easiest ways to success, the easiest ways to see progress, is when you make it boring.